Welcome back. Let's talk some bonds. Let's get ready for this week. Cooper Howard, Director and Fixed Income Strategist at Schwab Center for Financial Research, joins me alongside Michelle Gibley, Director of International Research. Good afternoon, team. Great to see you guys. Cooper, get us started here as we've got bonds seemingly unable to punch through 4-5 in the 10-year. What do you think is going to do it?
Yeah, I don't think it's too much of a surprise to see a little lack of movement today, Oliver. There are no major data releases that we've seen, so I think that we're seeing flat on the market. So again, not too big of a surprise. I think if we look back last week, obviously the big events were CPI, PPI, also Chairman Powell's speech on Friday. I think that was something to kind of give a little bit more of a cautious tone of the direction of interest rates. But if we look forward, for fixed income, it is relatively a light week in terms of what's going to be released this week. We get a little bit of data as far as housing numbers. We get the unemployment, the real-time claims as far as initial claims and continuing claims on Thursday. So maybe that shifts the narrative right now. But in terms of what I'm expecting, wouldn't be too surprising if we chop sideways a little bit in the short term.
We were talking earlier about Goldman's bullish dollar note. Seemed to kind of resonate with your guys' view of yields drifting higher from here. Those two tied together?
Yeah, I think to a degree they are tied together because ultimately it really comes down to Fed policy and what the direction for Fed policy is. And our view, and it recently has shifted in terms of our thinking on the direction of interest rates, is that we're a little bit more cautious in terms of taking on duration bets at this point. So if you take the totality of everything that could potentially occur, whether that's tariffs resulting in a trade war, whether it's a concern about immigration policies driving inflation higher, or tax policy driving inflation higher. Just taken all together, it's kind of like the balance of those risks is for higher yields. So we do think that it makes sense for investors to take a little bit cautious of an approach on duration. Right now, what we're suggesting, Oliver, is a benchmark or below duration. Now, that's going to vary based off of your investment tolerance. For most investors, that's about a 6-year average duration. So that's a good starting point of what we found for many of our clients, Oliver.
Understood. Okay. We got about a 62% chance of a cut in the market right now. If they don't, Michelle, how hard is that going to skew the Fed to the rest of the world, which is largely on a path of stimulation, support, and cutting rates still, like in unquestionably, right?
Yeah, I mean, I think the biggest impact will be on the dollar, just the potential for a faster pace of cuts outside of the U.S. and then expectation of slower cuts in the U.S. That's the reason the dollar has gone up so much. It's, maybe a little extended, and that does hurt international stock performance. But I would say that international stocks are still pretty inexpensive. If we look, just at the Eurozone in particular, let's say, the MSCI EMU index is trading 13 times next 12 months earnings. That's a 40% discount to the S&P 500.
Wow.
Typically it gets around 20% discount because it's a little bit different exposure in terms of sectors. It has less tech and more cyclical, but that's a pretty big discount. So it's already accounting for some pretty low expectations.
Yeah. Like that context, we got a little bit of a bounce in China stocks today. Finally, what will determine if they can get back on their feet, Michelle?
Yeah, I think we're really looking for fiscal stimulus. We had a package of 10 trillion yuan, 1.4 trillion US dollars at the beginning of November, right after the US election. But it really wasn't stimulus in the traditional sense. It was a local government debt restructuring. And we really have been missing fiscal stimulus to support demand. And it's really looking like a long drawn out process, probably more targeted at stabilizing rather than stimulating China's economy. And I think, markets are starting to lose patience. We'll get a couple more chances coming up. We got the mid-December Central Economic Work Conference, but we may not get the details until March, in which case, Chinese stocks could start to slip some more.
Okay. Michelle, the drop-off has been pretty intense for China, but rest of the world, does it look like they're in a post-Trump malaise?
The impact of tariffs would be negative for growth, but they're maybe a little bit smaller than what people expect. Exports to the U.S. for, let's say, China even is less than 3% of GDP. For Germany, it's around the same. They're probably going to be more targeted, the tariffs at autos, which are only 0.5% of Germany's GDP. So, we don't really even know how much of them will be implemented. So I think it's probably a little overstated in the near term.
All right, good stuff. Nice perspective, some good subject matter for us to mull over this week. Appreciate it. Thank you very much, Michelle Gibley, Cooper Howard. Good setup there for some major topics and a little balance in China.